Please be seated and come to order.
Good morning. We will begin the hearing. I appreciate everyone's flexibility this morning between the weather and school closings and travel problems. We thought it was the better course of caution to delay the hearing by 90 minutes, and so we are beginning it now at 11 o'clock. I appreciate the witnesses and others' patience as we work through this very important topic. Welcome also to what should be, we very much believe will be, the final hearing to be held here in this building. As many of you may have heard, and as was mentioned at our last hearing, the STB is approaching a long-planned relocation, and that should happen at the end of this month, and this building will be vacated, and so we look forward to welcoming you in the future at our new location at 395 East Street Southwest. Today's hearing focuses on the methodology that the STB uses to calculate the railroad industry's cost of capital, the subject of an advanced notice of proposed rulemaking issued by the board in September 2006. Some parties believe that our current method overstates the freight rail industry's cost of capital. I've come to learn just how important the cost of capital calculation is, both to the work of the board and to the rail industry and its customers. It is relied upon in many regulatory proceedings, including those prescribing maximum reasonable rate levels, setting compensation for disputed trackage rights fees in the proposed abandonment of rail lines, and in our rail costing methodology. Perhaps most significantly, it is relied upon in the board's annual revenue adequacy determination, a finding that has received even more attention in recent years. I am pleased to see here today representatives from the Federal Reserve to discuss its method of calculating cost of capital. I'm looking forward to hearing why the Federal Reserve chose the method it now relies upon. I'm sorry to report that the witnesses from the Canadian Transportation Agency, the CTA, will not be able to be here today to testify as planned. I understand that their flight was canceled and they were not able to get another flight in time to attend the hearing today. Nevertheless, the CTA's comments will be considered as part of the record in this matter. I'm also looking forward to our second panel, where we have experts with differing views on the methodology that should be relied upon by the board. I hope that by having the opportunity to probe this issue with you together on one panel, we'll have a productive dialogue. As I mentioned in at the beginning of my remarks, we will be relocating to 395 East Street Southwest within a few weeks. Right now, it looks like we'll be officially closed for normal business operations at this location as of 5 p.m. Wednesday, February 28th, and reopening at the new location on Monday morning, March 5th. We have put out a press release detailing the impacts of the move on our operations, and we will issue another release prior to the move, letting you know how to reach us should an emergency come up while our normal business operations are suspended. We'll keep our website updated with the current information as well. Now, before we begin, let me just take a few minutes to review a few procedural points about today's hearing. We will hear from panels with breaks as appropriate, although it's my hope that we can get right through without anything in the way of a long break. We will hear from all the speakers on a panel, one at a time. Our timing and light system that you may be accustomed to is not operating today, so don't worry about that. You will not be seeing the red and green light you might be accustomed to from prior hearings. We will do our best, though, to keep time the old-fashioned way, in the time that you've been allotted. And I will try to keep an eye on the clock as well and let you know if it is time for you to wrap up. After hearing from the entire panel, we will rotate with questions from each board member until we've exhausted the questions. Consistent with board practice, we will allow all the witnesses on each panel to make full presentations before the members ask questions. Finally, just a reminder to please turn off any cell phones. I certainly look forward to a very interesting day of testimony, and with that, I will recognize Vice Chairman Buttry for any opening statement he may have.
Good morning, Mr. Chairman. Good morning to the people here today for the hearing. Looking forward to the testimony, and I have no formal opening.
Commissioner Mulvey.
Thank you, Chairman Nottingham, and good morning and welcome to our panelists from the Federal Reserve Board, ship and railroad organizations, analysts, and guests. I'm pleased today that we have convened this hearing on the cost of capital. The Board's purpose in calculating the cost of capital is primarily for use as a benchmark for determining whether the railroads are revenue adequate or not. In examining our methods today, we are fulfilling several Board mandates and policy objectives. One is to periodically review our cost accounting rules and make changes in those rules as required. Another is to ensure the availability of accurate cost information in regulatory proceedings. And yet another is to encourage honest and efficient management in railroads. It is important to note that the approach we take in calculating the cost of capital not only determines railroad revenue adequacy, but also has implications for our rate cases, abandonments, and for the Uniform Rail Costing System, or IRCS. The ICC adopted the discounted cash flow approach approximately 25 years ago. And as such, perhaps the more appropriate inquiry today is not whether or not it was the best approach at that time, but rather, is it the best approach today? There have been numerous advances in finance theory over the last few decades, especially on our ability to understand and to empirically estimate and measure risk. And those advances need to be taken into account in the way the Board approaches measuring the cost of capital for the railroad industry. Today's hearing will explore the arguments made by some that our current methods, that is the discounted cash flow approach, is seriously flawed, and that we should consider alternatives. One approach to addressing their critiques would be to change how we conduct the DCF analysis. Another approach would be to replace our DCF analysis entirely with the so-called CAP-M methodology. And yet another approach would be for us to combine certain elements or to average both the DCF and CAP-M analyses. I personally am not wedded to any approach. Rather, I simply want to ensure that we are using the most accurate and acceptable method today. In that vein, I am eager to hear today's testimony and to engage in a dialogue with the witnesses. On a personal note, today marks several changes. As Chairman Nottingham mentioned, this will be our last hearing in this room. We've had 10 good years of hearings in this room, but we're looking forward to our new quarters. And it's not only our last hearing here, but it's also the last hearing for one of my staff members, my counsel, and my long-term colleague, Amy Scarton, will be leaving us to go work again for the United States Congress. And I'm sure we all wish her well and look forward to seeing her career progress over the next few years. So thank you, Amy, for all you've done for myself and for the STB over the last few years.
Thank you, Commissioner Mulvey. And I know that Vice Chairman Buttry and I certainly want to associate ourselves with your remarks about Amy Scarton. She will be very much missed here and has provided outstanding service to the Board. We wish you well, Amy. We're very delighted today to have a colleague from the Federal Reserve with us, Mr. Gregory L. Evans, the Assistant Director of the Division of Reserve Bank Operations and Payment Systems. Without further ado, the floor is yours, Mr. Evans. Welcome.
Thank you. I'd like to say thank you for inviting me to discuss the Federal Reserve's experience in using various models to calculate return on equity. Over the past 25 years, sounds like similar to you, we've considered this topic in depth, and I hope that some of the lessons that we've learned and conclusions that we've reached will be of some assistance to you as you consider your approach. My written testimony, of course, contains a much more complete summary of our experiences and the framework in which we use this information. But in the interest of time, I will limit most of my comments this morning to our recent adoption of a CAP-M only approach to calculating a target return on equity for the Federal Reserve's price services. First, it might be helpful for me to explain briefly why the subject of calculating return on equity is so important to the Federal Reserve. The Monetary Control Act of 1980 requires us to establish fees for our price services in such a way that fosters competition from private sector service providers, while at the same time ensuring an adequate level of such services nationwide. Over the long run, we must establish fees for price services on the basis of all direct and indirect costs actually incurred in providing those services, as well as imputed costs. Imputed costs include financing costs, return on equity, taxes, and other expenses that would be incurred if it were a private business firm providing these services rather than the central bank. These imputed costs, including the imputed return on equity, are collectively referred to as the Private Sector Adjustment Factor, or PSAF, which we estimate annually. And I will use PSAF, and please forgive me for the acronym in order to shorten this. Calculating the PSAF is a forward-looking practice that involves estimating the book value of Federal Reserve assets and liabilities to be used in providing price services during the coming year, and imputing those other financial statement components, such as equity, that would exist if these services were provided by a private sector firm in the banking industry. We then calculate a cost of equity for the price services as a whole by applying an estimated private sector return on equity to the dollar amount of that equity. Determining an appropriate target return on equity for our price services, and in particular identifying a suitable private sector peer group, has been one of the most challenging aspects of calculating the PSAF. For the first 20 years, the Federal Reserve calculated a target return on equity from consolidated audited financial data for the nation's largest bank holding companies on an equally weighted average of the ratios of each bank holding company's net income to its average book value of equity. While we recognize the limitations of using bank holding companies as a peer group, they were considered to be the most reasonable proxy at the time because their operations most closely resembled those of our price services. They often competed with us in providing payment services, and they had audited financial data that was publicly available and afforded an appropriate sample size. Eventually, however, other finance theories began to gain broader industry acceptances, and changes in the bank holding company activities weakened the comparability of this peer group to our price services, leading us to consider changing our approach. In particular, we sought to eliminate or at least diminish a number of inherent weaknesses in the accounting-based approach. So, beginning with the 2002 pricing process, which happens in the fall of 2001, we adopted an equally weighted three-model approach using a combination of the existing accounting-based model and adding two additional economic models, the capital asset pricing model, CAPM, and a discounted cash flow, or DCF model. We chose to combine the results of these models in order to estimate a target return on equity because they each use different assumptions, analytical approaches, and data sources, and were all widely used in industry, regulatory, and academic situations. The discounted cash flow model incorporated projections of future returns that were not reflected in the accounting-based model, and unlike the accounting-based model, however, it required knowing the individual stock prices as well as forecasts of future dividends and long-term dividend growth rates for each bank holding company in the peer group. The capital asset pricing model uses market return data to provide a theoretically sound basis for estimating a prospective return on equity. Its basic principle that the required rate of return on a firm's equity is equal to the return on a risk-free asset plus a risk premium that can be estimated is relatively intuitive, in that the higher the risk of the entity, the higher its expected return must be to attract investors. Very straightforward. Because academic studies had demonstrated that using multiple models could improve estimation techniques when each model provided new information, we chose to combine all three models. We included the accounting-based model despite its shortcomings because its results complemented the market-driven results of the other two models when combined. When we first adopted the three-model approach in 2001 for 2002 prices, there was evidence that multiple models were being used by academics and professionals to estimate return on equity. Subsequently, however, as academic, market, and financial service industry practices continued to evolve, the weaknesses of the accounting and DCF models became more widely recognized, and reliance on these models for targeting a firm's return on equity began to decline. Although the DCF model is a powerful valuation tool in theory, its results depend on analysts' ability to project cash flow and dividend growth rates accurately, and research findings suggested that analyst dividends projections could be upwardly or downwardly biased. Financial market history also demonstrates the inherent difficulty faced by analysts in developing accurate financial projections, given the rapid shifts in business activities and environmental factors. Although some public utilities still use the DCF model together with a CAPM for developing return on equity targets, the DCF method was not used by many larger financial institutions. With this information suggesting that 2 of the 3 models in our 3-model approach might not be in line with current practice, and because the CAPM was widely accepted and used more in practice than the other methods, we evaluated the possibility of discontinuing the 3-model approach in favor of a more appropriate method such as the cap-only approach. During this review, begun in 2004, we worked with an external consulting firm that specialized in capital allocation and risk management, and with 4 finance professors from U.S. academic institutions in order to obtain information about current private sector practices. In addition, we requested public comment on a variety of topics related to the 3 models we were using. Overall, the public comments we received were mixed regarding the theory, use, and components of our 3-model approach and our proposed return on equity methodologies. Generally, commenters supported using the CAPM only method because it was simple and theoretically the best model. None of the commenters supported the DCF model as a standalone option. One commenter opposed using the CAPM because it would create volatility in Federal Reserve pricing. Overall, we found the CAPM methodology to be a well-known, widely used, and theoretically sound model that was simple and transparent compared to other approaches. Because we strive to use a PSAP that is consistent with private sector practice and that the public can easily replicate, we elected to use the CAPM-only approach with some modifications, beginning with the 2006 price-setting process, which was done in the fall of 2005. Now, before delving into some of the more technical issues we addressed when adopting the CAPM-only approach, it might be useful to spend just a moment reviewing the CAPM formula. The CAPM's basic principle is that the required rate of return on a firm's equity is equal to the return on a risk-free asset plus a risk premium. The risk-free asset is an investment with no or low risk, typically measured using a treasury rate. The risk premium is a combined measurement of the additional return investors require to forego the safety of investing in low-risk or risk-free assets and the market risk of a particular company, also relative to the risk of the overall market. The CAPM's results are highly sensitive to these inputs, which are critical to the model's usefulness. For that reason, we requested public comment on all these inputs before we moved to the CAPM-only approach. Excuse me, I lost a page. There it is. For example, we requested public comment on whether our risk-free rate should be based on a short-term rate or a longer-term rate. The comments received varied significantly. Ultimately, we did not believe that one approach produced conceptually superior results over the other, and over time they should produce the same results after adjusting for term premiums. So we concluded, therefore, that a 3-month Treasury bill rate was appropriate for use as a risk-free rate in our return on equity calculation, partly because it was also consistent with a rate that's used in a separate imputed income calculation that we use in our price-setting formula. Although we did not specifically request public comment on the estimated market risk premium, some commenters suggested to us that our prior methodology of using historical monthly average excess returns of the market over the 1-month T-bill rate since 1927 did not properly reflect more recent equity and bond market conditions. And we ultimately elected to adopt a rolling 40-year time horizon to estimate the market risk premium. We concluded that a rolling average would better capture evolving attitudes and changes in expectations because less relevant historical data results would be replaced with more relevant and recent data. We also believe that 40 years was sufficiently long enough to smooth cyclical fluctuations in realized returns, but short enough to reflect trends in required returns. Then, of course, was how to compute the beta. As you know, a key assumption in the CAPM is the beta, which measures the sensitivity of a firm's returns to the overall market returns. Betas greater than 1 indicate greater sensitivity to market changes. Betas below 1 indicate less sensitivity. In order to calculate a beta representative of the Federal Reserve's price services, we need historical information for a comparable peer group. In addition, technical decisions need to be made regarding how much historical information to use and in what manner. In our request for comment, we specifically requested comment on alternatives for choosing a suitable peer group. The comments we received, however, were highly diverse and offered no real consensus. We also requested public comment on the beta estimation period and on whether to weight bank holding company returns equally or by value, given that valuating the bank holding companies based on market capitalization was becoming less useful as bank holding companies were becoming more and more involved in non-payments related businesses. Here again, the comments received varied widely without a clear consensus. Given the varied perspectives on how to estimate an appropriate beta from historical data and the recognition that historical betas in general may not be good predictors of the future risk of a firm that might be facing different risks in the future than it did in the past, we considered the idea of simply assuming a beta of 1. Assigning a beta of 1 to a firm assumes that investing in the firm's equity carries the same risk as the market with the same expectations for return. Finance literature suggests that betas, as an empirical rule, move towards 1 over time, and experience shows this to be the case for correspondent banks and other firms that provide payments processing services. In our request for public comment, we noted that the long-standing difficulties associated with selecting a peer group and estimating the appropriate peer group beta could be eliminated by simply assuming a beta of 1 for our price services. This would also eliminate the need to make a judgment on the beta estimation period and peer group weighting. Of the 5 commenters that addressed the beta equal to 1 assumption, 3 expressed a preference for developing a beta based on a peer group. These commenters, however, also recognized the difficulty facing the Federal Reserve in finding a comparable peer group and recommended different peer groups. One commenter supported the idea of setting the beta equal to 1, indicating that that was a reasonable, simplifying assumption in view of the uniqueness of the Federal Reserve's payments business. Another indicated a preference for a static beta as opposed to one determined using a peer group, but made no suggestions to us for how to derive that beta. From the comments we received, and in recognition of the many theoretical and practical challenges we have faced over the years in applying the peer group approach, we elected to forego the long-standing practice of identifying a peer group to calculate a target return on equity for our price services. Instead, we adopted a static beta of 1 for our price services because it's simple to understand, administer, and monitor while providing reasonable results. In conclusion, our decision to replace the 3-model approach with a CAPM only method reflected our desire to alleviate the ongoing dilemma of identifying an appropriate peer group for our price services and to adopt a simpler, more straightforward and transparent approach that is widely accepted within academic and industry circles. Our targeted return on equity is now estimated by adding the 3-month T-bill rate to the rolling 40-year average of excess market returns over the short-term T-bill rate. We've used this CAPM only model for setting our 2006 and our 2007 prices. The targeted after-tax return on equity for those years was targeted at 8.91% and 10.82% respectively. Thank you again for inviting me to provide this information. We appreciate this opportunity to share our experiences in estimating return on equity with you, and we'd welcome future dialogue, especially at the staff level. I would now be happy to respond to questions.
Thank you, Mr. Evans, for your very thoughtful comments, and I do have some questions. First, just to help us understand a little bit your world. It's not every day we have the Federal Reserve with us. Right. Tell me a little bit about the priced services that is behind your whole reason you guys do this.
The price service, basically we provide services to depository institutions, large commercial banks, small banks. They are like check clearing services, wire transfer services, ACH, automated, direct deposit type services. I probably left one out here. Book entry securities are a portion of that practice. They're basically provided to depository institutions, and we do have competitors in each of those products. Even though we may have a market share of 45 to 60% in some of those services, there are private sector competitors to every one of them.
Generally speaking, is there any, in your experience, any meaningful correlation if we're looking at an industry that, as we are, that has in recent years experienced pretty significant increases in earnings and increases in stock valuation? In that environment, would we generally expect to see cost of capital go down, stay flat, go up?
I'm trying to think how to apply that to our world, because in our world, clearly we've got a couple of things going on. We've got a very changing dynamic with the electronification of price services, and so some of these discussions about what to expect and whether cost of capital should be higher or lower in that environment are highly debated even within our own organization. There are those who would suggest that in a fast-changing, risky business, you should expect higher returns. There are others who believe that we have a more stable basis and we'd have lower returns. What we've found with CAPM practically is that it's really the short-term interest rate that drives its results the most. The other thing that I will take a stab at delving into to help you understand how our world's a little bit different is when you talk about changes in required return on equity, we're clearly taking a market-based estimation methodology to come up with a target return on equity. Our dilemma is that we don't have a true market capitalization number, the number you apply it to. Our equity number is based on a book value. We try to maintain our pricing methodology so that you can assume that this mythical entity or imputed entity would maintain stable stock prices, but we don't have a marketplace where we can go out and validate because we don't have a stock that goes up or down. The price service Fed does not sell shares. And so it's really the equity component that I think is probably where you're at that gives us the most struggle over the years is we can come up with great market-based rates, but then what equity level do we apply it to? I'm not sure that quite answered your question, but it'll give a flavor of why that's a different twist for us. No market cap.
And in your business and the services you provide, do you face when you get comments on this issue? Is it fair to say you get comments at least from two perspectives? One being the recipients of your services who would have an interest in seeing your costs kept low.
Typically, the comments over the 20 years I've seen a variety of. Some public comment periods are very robust comments, some very light. Yes, there's usually, you can see that the people who want our prices to be lower because they're relying on us to provide an alternative to the other private sector providers. There's also those who would like to see our prices higher because they're our direct competitors. But it's been interesting over the years that, generally speaking, my characterization would be that despite those different perspectives, we do get thoughtful comment along theoretical grounds because I think we've built a reputation that it's not the number of comments as much as the reasoning behind the comments that we value the most. Unfortunately, in this arena, you can get an awful lot of very sensible comments that are opposed to each other. That's putting it bluntly.
Thank you. Our charge, of course, as you know, is to look at the freight rail industry and to implement the laws and regulations that have developed around that industry. The risk factor and the importance of risk factor is something that I'm hoping to explore more today and spend some more quality time thinking through. As you can imagine, the freight rail industry is unlike the back office of a financial institution where it may be a fairly somewhat controlled environment. You've got heavy machinery and personnel deployed out in the field across the country. The issue of risk, and you add that the common carrier obligation that we impose on the freight railroads. They don't have the luxury of saying declining or turning away commodities or goods that they're asked to carry. Raises issues like hazardous materials liability and whatnot. And you add to that the overarching policy challenge of the tort liability system we have in our country. And you have the risk premium raises its head in a myriad of ways, just to put it lightly, in the freight rail sector. Not to mention I'll say the political risks of trying to look ahead and discern where Congress or this agency or other agencies that may have an impact on the freight rail sector might go policy-wise. Do you have any experience or anything in your work that would help us think through that in a rational way? Any similarities in some of the work you do, or are we just out there on our own and dealing with a completely unique situation?
I'm not sure if you're out there on your own. I'm also not sure if I'm the best person, but let me give you kind of an initial gut reaction to what you're saying. Part of that is the peer group dilemma. I mean, if you have a peer play, peer group, people facing similar risks, and you can look at their market experience, obviously it can help you with something like CAPM. We debated internally on, for example, what equity level to establish for our price services Fed. And, using what banking regulators would look at. You could look at a Basel II type approach where you look at the operations risks and the financial risks and the credit risk and try and figure out what the right level of equity is. We have not yet explored applying that in depth to this process. I will tell you a few of us have bantered those ideas around. Right now the systems aren't in place to do it quite that way. What instead we have done, it's arguably the best we can do with this approach, is we still pretend as though our price service fed is a bank, and we apply the same risk type measures that the regulators would apply to a commercial bank, and that kind of forces us to get at a particular equity level. But I will tell you, even in delving into some of these models, we recognize that our price services equity was generally less as a proportion of total asset than other bank holding companies, but we thought that made sense because the suite of services and activities we were involved in were very different than that of commercial banks. But it raised issues of, do you leverage, or do we need to leverage some of these rates because of our debt to equity levels are so very different. So that's a long roundabout way of saying I understand your issue. We don't have an easy answer on, independent of finding a peer play, peer group, of establishing a right risk measure without it being arbitrary or looking like it was an official policy of the board. And that's another one of our challenges that didn't come through in this, is that we spend a lot of effort to make sure that nothing we do in setting our price services and picking these rates and assuming these assumptions give any predictive nature to future policies of the Federal Reserve Board. That's why we rely so heavily on recreatable, publicly identified, very transparent information, because you can imagine the dilemma we would be in otherwise.
Thank you. I'd like to turn to Vice Chairman Buckley for any questions. Thank you, Mr. Chairman. I think any deliberative body, as we are, in taking testimony from time to time on issues, have to be concerned about the probative value of that testimony. And I was particularly interested in focusing on your methodology for picking a peer group. I want to just get some information on the record here, if I could. Banks are not big users of fuel, I don't suppose. There's a huge cost in our part of the world, which is a very volatile price issue these days. And I would assume, and you correct me if I'm wrong, that your business is more technology sensitive than it is labor sensitive. I would suspect that you're more technology intensive than you are labor intensive. Is that correct?
And you're going to want some statistics that I didn't come in hand with. I think I appreciate your instincts, but there are a couple of nuances, and we are in a changing world right now. If you can imagine transporting paper checks across the country, there's a lot of transportation costs, which can be fuel sensitive involved, and the
that doesn't happen much anymore, does it? That's mostly wire transfers and electronic transfers. I certainly hope you're going to tell me that, because as a bank customer, I would like to know that that's happening.
We understand it is happening, and we see it happening. And
I used to work for a little company that carried a lot of bank checks at one time. I recall that business pretty well.
Yeah. Let me give you some personnel numbers that might help. Our commercial check area, of the 3,319 people involved, system-wide in these payment services, almost 3,200 of them are still in the check clearing business. And so there still are an awful lot of paper checks still being cleared, some of which we are moving toward with Check 21, converting some of them to electronic images and then printing them out at the other side. But there still is a fair amount of transportation involved. But you're right, we all hope to see that go down.
Can you give me any numbers on how many of those employees are unionized?
Zero.
Pardon me?
Zero.
Zero. That's what I thought you said. None of your prices are regulated in any way, is that correct? Neither your peer group prices or your prices.
This approach is the closest thing to regulation. The Board of Governors needs to approve the prices the Reserve Banks charge, and it is this process I'm talking about is the closest thing to regulation. Our responsibility to comply with the Monetary Control Act, but short of that, no.
Do you have any idea, any feel for what the average amortization period would be for your heavy equipment like hardware, computer hardware, and that sort of thing?
Typically 5 years, unless it was a special case where it was going to, a certain production equipment would go up to 20 years.
And you can expense those items up to what level? Up to what level, individual unit level? You can expense some of those items.
Yes. So currently, our capitalization threshold is $5,000.
$5,000. Okay. You don't have any problems in the debt equity ratio area, I don't suppose.
No, I tried to spare you some of that discussion, but one of the things that we have on our banking balance sheet is our customers hold compensating balances with us that they use to clear transactions, and in those balances are more than exceed what we would possibly need to fund the fixed assets of the price services business. In fact, it's so much so that we have to pretend as though they are invested in a basket of goods, and we go through an awful lot of gyrations to make sure it's a fair investment type pool, and that I spoke earlier about our imputing investment income to ourselves, and that uses a 3-month T-bill rate as part of that equation. That's what I was referring to. So for our price services Fed, we don't compute a debt equity ratio per se, because we already have on this balance sheet, well in excess of enough debt in the form of core clearing balances to fund the transactions. If that gets at your point.
And your activities at Federal Reserve, the 12 districts of the Federal Reserve, and the operations activities of your peer group, I presume are all conducted inside with no heavy lifting.
I'm sure someone's going to point out to me that I'm wrong, but generally, no, other than
in a climate-controlled environment, so to speak.
Right.
Okay.
Generally speaking.
Thank you very much. I appreciate it.
Commissioner Mulvey, questions?
You put together a peer group because you don't yourself have equity, and my question here is this, and this is an important factor in what you did and how you worked out the decision to move from one group to the next, but we have the railroads. We don't really need to do a peer group for our analysis, right? Wouldn't we be using the railroads? So the peer group stuff and whether or not and how you would go about choosing it is not really particularly important for our consideration here, because we would use the railroads as their own group. Okay, thank you. Wanted to clarify that. Would you say that you talk to a lot of academic professionals and other consultants, et cetera, did you find that there was a consensus developing away from the DCF approach and towards the CAPM approach in academia and amongst other financial experts?
That was the impression we got from our consultant and working with academics. Clearly, there are those who like to continue to compute a DCF approach just as kind of like a reality check on the results of the other models, but that we found that their preferences for the CAPM method and what it portrayed and how it was computed.
There's always this debate between whether or not truth is absolute or relative, and I guess the same can also be applied to methodologies. Is it likely that a DCF kind of methodology or some other methodology might be more appropriate in one economic environment or one period of time, and then another period of time the CAPM approach would be the more correct, if you like, approach, and that could change back and forth again over time? Or do you think there's some sort of progression here from a flawed methodology to a more accurate one? That's a philosophical question.
It's a philosophical question that I'm not sure the board has taken a position on, but I will give you my impression. My impression is the answer is probably right. The problem you have is then how do you maintain credibility that you're not just picking and choosing the approach that gives you the answer you want, and that's the underlying problem. But I will tell you that as we went through the last decade, we did recognize that we were on a journey, and that journey was probably going to leave my favorite accounting model off to the side, and we were going to move to something else, being an accountant by trade. And so I think we saw the 3 model as perhaps a stopping point. I think at that point we thought we were going to wind up with a blend of DCF and CAPM. What really took us all the way to the CAPM beta of 1 was this continuing struggle we had with seeing that our peer group was getting so very difficult to get at the really relevant data. We saw there was a false sense of precision. We found a way to simplify a process and be much more transparent about what we were doing, and that probably is the reason DCF didn't come along with us into that next model, in all frankness, my opinion.
Well, we're lucky in the sense that we don't have to do the peer group. I think that's a benefit that we have here. So, one of the testifiers today is going to say that one of the advantages of the DCF approach is that it's forward-looking, in the sense that it relies upon analyst projections of future dividends and earnings, whereas the CAP-M approach is backward-looking, in the sense that it looks at the past history. Would you comment on that characterization of the two approaches?
Sure, I'd love to. Recognize that we came from an accounting-based model, but which was the ultimate backward-looking model, so that even CAP-M seems forward-looking to us, because it uses at least a current risk-free rate, which is more forward-looking than what we had used in the past. So that gives you a sense of our environment, where we were coming from something that was looking at 5 years back, 250 samples, and much different. The problem you have with DCF, in my opinion, is you're still trusting analyst projections, and there's a variety. We noticed that there was an awful lot of research that was starting to become more and more prevalent about whether or not there was a bias. Now, you could say it was always upward, you could say it was always downward, but I think that always made us a little intuitively uneasy about, if you get to where you only have a few analysts in a particular area, covering area, just how reliable that was, and CAP-M gave us, a different model to get out of that problem. I hope that kind of gets it.
That does. Yeah, one of the problems, of course, is that there's variability amongst the analyst forecasts, and in fact, what we've seen in some of the testimonies is that there was quite a bit of variation between what the various analysts forecast for future dividend growth. On this question of the appropriate interest rate on a risk-free asset versus long-term versus short-term, as Chairman Buttrey noted, or I think was suggesting, hinting at, was that the railroad assets are very, very long-lived. And banking assets, as you say, 5 years is for a fixed asset. Would you say that would suggest that for the railroads we ought to look to more the long-term interest rate as opposed to a short-term rate? Would that prejudice one way, bias it one way or the other?
Suffice it to say, we have spent hours on the risk-free rate and long-term, short-term, because our mandate under the Monetary Control Act is to recover prices in the long term.
Right.
An undefined long term, but long term nonetheless. And that was one of our concerns, and there were some that advocated using like a 10-year Treasury rate. But then we recognized there was a term premium built in there, and we spent a lot of effort on ways to try to estimate and carve out that term premium. And here again, trying to make sure it was fair and replicable and not self-serving. But at the end of the day, we felt that it was important to have the risk-free rate used in the beginning of the equation as close as possible to the risk-free rate you use in estimating your estimated market, risk premium, and that those rates be as close as possible. And we concluded a short-term rate was acceptable, that over time they would essentially become the same, and then ultimately, because we used a 3-month T-bill rate in another part of our imputed methodology, it made sense for them to be consistent so that our imputed enterprise wasn't schizophrenic about how some of its things worked. Does that get at what you're after there?
I was wondering what the sensitivity was between using the short-term and the long-term rate in terms of your course of
a lot of theoretical debates about whether you were biasing your rates too high by using a long-term rate, because essentially CAP-M is saying the short-term risk-free rate,
right.
You want to take out other risks, and the longer your term goes, the more you have additional risks factored into it. But I would say we spent a lot. We even had a creative way of starting with a 10-year rate and taking out an average term premium in order to get a rate that some people thought was still more longer term, getting at the point of trying to match the longer term with the cycle. And that's probably one of those that we could pull together a few of our economists with yours and share some of that robust dialogue. But in the end, we couldn't conclude any one being, more superior to the other, but the numbers do come out different.
We would appreciate greatly that cooperation and that help. One last question on the railroad beta, or what the railroad beta might be. You chose a beta of 1, and from what I read in your testimony, it seemed for good reason. But the railroads are a fairly stable industry, and one would think that the railroad beta would be less than 1. Would you suspect, or do you have any?
I'm not sure I'm an expert in that, but from what I understood in preparing for this, most estimates are less than 1.
Mm-hmm. But we're seeing estimates of railroad betas as high as 1.4. which struck me as particularly high for railroad beta, and I just wonder if you
I
could...
really wouldn't.
Yeah, okay.
Thank you.
Well, thank you very much. That's all for my...
Mr. Evans, if I could, in your experience, does the methodology, whichever one is used, CAPM, let's assume it's whatever one's generally viewed as the most useful and most accurate, does it matter what purpose the user has for that model? In other words, you're using it to look at banking industry costs, and of course we would be using it for very different purposes. Should the model basically stand up regardless of really what the ultimate use is of it?
If I'm understanding your question correctly, I think a model should stand up for what it portrays to do, but you need to be careful that you don't assume that it does more than it's designed to do. And so I think feel we have a responsibility to approach our entire pricing formula, if you will, to make sure that it's robust and leads to efficient pricing. And so that's why we periodically review it. If using the CAPM model in the way in which we do would somehow violate that greater objective, well then we would be back to another fundamental review, another examination of what's broken, does it need to be fixed. So I think if you're asking, I think you always have to keep in mind the end product and the end goal and make sure you're achieving those and not adhere rigidly to a model if it's broken for your application. It's a highly subjective and debated issue sometimes about whether it is broken, but I think we're constantly looking for the perfect solution. And that's one of the reasons I'm excited to be here. I'm going to see if I hear one later.
How important is it, in your opinion, to look at market practices? For example, if your competitors, folks in the private sector who provide similar services, if they were generally speaking all using CAPM is that a meaningful fact, or is that just possibly some random decision?
I think it's meaningful for us because here again, our goal is to impute a private sector-like approach and factor. We want to behave just as we think we would behave if we were a private sector entity. So if all of our competitors typically use one model, gee, the best way of estimating that would be to see how they're doing it. Now, granted, if someone came up with a superior method, but at the end of the day, comparable entities compete for the same capital in the marketplace, and so if most are using one method and it's working, it would seem logical to conclude that maybe that's what you would use if you, in our case, trying to impute something. Our problem was that comparable peer group for our particular suite of services was just so difficult.
Okay. Can you shed any light for us on common practices around the federal government, other agencies that look at this issue? Is there such a thing as a best practice that's established out there that we should be mindful of? Or
to be frank with you, I don't think that we are that familiar with the other practices. As we did our search, we did find a regulatory commission in a state that used the 3-model approach. That's what turned us on to that idea originally. I was interested to see that you were debating the same thing, so I think we're looking to, we're always looking for a better method, a better way, and understanding and building on what other people are doing, but I'm not sure I'm familiar with any other practices other than there's a variety of rates available out there and a variety of websites.
And just at the risk of oversimplifying, you I think touched on this before. When we're looking at and talking about forecasting and methodologies, pretty much by their nature they're not designed to be 100% accurate. I mean, they're hopefully the most accurate we can get. Sort of mindful. I used to do a lot of traffic forecasting type work and past work, and people would, in the heat of discussions about public infrastructure projects, they'd say, "Well, that estimate it's not accurate." Well, yeah, no traffic forecast is 100% accurate, but you try to find the best one that's based on the most reasonable data. Is that really the same thing here, or is this really a quest to nail it up with 100% precision?
The problem is we don't know if we missed it or not, frankly, because it's an estimation of what our target would be if we were a company looking forward. And we can look to see what we hit, but if you aren't sure about your peer group, it's hard to say whether you really were comparable or not. Now, we can look, obviously, to the effect our prices are having in the marketplace, and that can give you a little sense. But by and large, these are estimates. you do the best you can, but we're in a unique situation where we can't even necessarily take perspectives on what we think the future will be. We've got to make sure we ground these estimates in things that are historically available outside just because of who we are. The Federal Reserve, to make predictions about the future, gets a lot of people's attention.
Sure.
And so, to that extent, I'm not sure if you have a little more reign on that, but that's one of our dilemmas in any type of prediction. And there are lots of predictions, you know, in accounting, benefit accounting, actuarial sciences. So, I mean, we're pretty committed to backward-looking, easily replicatable, you know, non-subjective assumptions in accounting and these types of circumstances. Does that make sense?
Vice Chairman Buttrick, any further questions? Commissioner Mulvey?
One question on the use of measuring equity, whether to use book value or market value in calculating equity. Do you have any views on that? Which is the most...
Clearly, the way we look at it is the mechanism used to compute these returns on equity uses market capitalization. That's a market-based measure of equity. Our problem is that we don't have one of those, and we have some debates internally. We have to use some measure of book value. I will, as an aside, more than you probably want to know, note that in this year's price-setting process, we were faced with a new accounting standard that required us to make an entry straight to equity, and we had to wrestle with what would that really mean to our market capitalization. Does this mean that this new information represents a drop in market cap or not? And so we are just starting to wrestle through these challenges that are going to come with more and more accounting standards like that. In this case, the most logical framework was to assume that that information on pensions did represent either an increase or a decrease to market equity, and it would be, and that our price service and provider would adjust their equity levels appropriately based on what the regulators required, but that our new market cap would reflect that economic reality that we are assuming happened in the marketplace. But that's the first time we've had to be that explicit. Up until this point, we've just assumed book equal market cap, and it's worked pretty well, but it's debatable.
Thank you very much.
Just one last question. Do you look at other international models that you look at? Do you look at what the English are doing, or the Swiss, or anything that's similar, you know, countries that may possibly have a similar
Not formally. I've got some informal contacts, so we've discussed these in various seminars, but they're usually more interested in what we're doing, frankly. They're usually quizzing me on that. So.
Vice Chairman Buttrick? Commissioner Mulvey? Well, thank you, Mr. Evans. We very much appreciate your time today, and look forward to studying your comments and your statements, and thank you. Good luck to you. We'll call the next panel up.